Hello and welcome, ladies and gentlemen. My name is Samir Shah, and I'm an M&A partner with Khaitan and Company's corporate M&A practice. Welcome once again to the ninth edition of our M&A Academy program. We have all but one more session to go, and with each session, we are ever more convinced that this entire initiative has been received very well. As always, our registrations with each webinar are cumulatively higher than what we've had for the last several webinars. The entire M&A Academy program was conceived to provide foundational legal knowledge and training in M&A transactional processes to corporate executives and other M&A ecosystem participants, but all in a corporate-like training environment. Our subject today is key tax issues in M&A transactions for buyers. On a lighter note, as they always say, nothing is certain in life other than change, tax, and end of life. And therefore, as with the whole host of issues that affect M&A transactional work, it is important to have a good understanding of tax issues. And we felt we would split these from the vantage point of the buyer and the seller. And today we will be addressing key tax issues as they impact buyers in M&A transactions. As always, we have a presentation which will be followed by a Q&A session. Post the presentation, the PowerPoint, the recording of the session, a summary of all the notes, and the recording will also be made available to all our registrants. The recordings of this session as well as all earlier sessions will also be available online to all of our participants as well as to the external world. To introduce our speaker today, we have my partner Indruj Rai, who is a tax partner based out of our NCR office, although he works on projects nationally and internationally. We circulated his profile to all of our registrants, and as you would have seen, he is an expert in his area and has a lot of experience in advising clients on transactions across the world, including his advice to Rolls-Royce and Mercedes on their global business carve-outs. So without further ado, I now invite Indruj to deliver his presentation. Indruj, over to you.
Thank you, Samir. We do have a very interesting topic today. And while one may wonder, what does a buyer have to do with taxes when it's just acquiring a business? Well, there is a lot. We will talk about acquisitions by buyers in different forms. So we will cover share acquisitions where an entire entity is acquired by the buyer. We will talk about specific businesses being acquired by the buyer by way of a slump sale. And we'll also talk about individual assets that are acquired. Now, each of these modes have their own set of complications and areas to look at for the buyers. We will, in principle, cover for the buyers to know what withholding tax obligation do they have and how can they mitigate any exposure with reference to such withholding obligation. We'll also talk about any deemed taxes that can apply on the buyer if they do a discounted acquisition of any of these businesses. There's areas in which a seller's liability, tax liability, can be recovered from the buyer. We'll make sure that the buyer protects itself against that and looks at the clauses that are relevant. Overall, we'll look at the documents that are there and the contractual protection that a buyer may want to ensure in those documents. We'll end with key takeaways and also take a Q&A session. Like Samir mentioned, please drop your questions during the webinar. Next slide, please. We'll start with share transfers. So like I articulated, share transfer is where buyer is acquiring an entire company. Like we know, a company is a separate legal entity. So when a buyer acquires a company, along with the company come all the legacy issues that are there. So we want to make sure that the buyer is well protected and discharging its tax obligations. Generally, there's a long form agreement that's entered, what we call a share purchase agreement, where contractual rights are recorded. Next slide, please. While we wait for the slide to move. Okay, thanks, Samir. So the first and foremost thing we'll cover is actually the withholding tax obligations that are there on a buyer. Now, like I articulated, it's actually the seller who's making the income and is liable to pay taxes. But the Indian Income Tax Act casts an obligation on a buyer to look at what taxes are payable by the seller and ensure that the buyer actually collects those taxes and pays it to the government. The intent is early collection of taxes by the government and also certainty not to wait for the seller to actually do the filings. Now, there are severe consequences for a default by a buyer in not withholding the obligations. The taxes which are otherwise recoverable from the seller can also be recovered from the buyer if they default in paying those taxes. You would have all known of the infamous Vodafone tax case. In that case, Vodafone was actually the buyer, not the seller. It hadn't made the gains, but was responsible to pay the taxes. Therefore, withholding obligation becomes very important. There's another element that the buyer has to keep in mind when looking at withholding obligation. In many cases, the buyer can be treated as agent of the seller. And if the seller defaults in payment of taxes, the taxes can be recovered from the buyer. This is even where a tax is payable over and above the withholding obligation. So the buyer wants to be very clear of the taxes payable by the seller, which are covered by withholding and otherwise, and try and ensure it's collecting all those taxes. When it comes to taxation around withholding, it all depends on the residential status of the parties, the seller and the buyer. We've bucketized those into three different items over here. The first, which is probably the most important and most vast in scope, is where the seller is a non-resident. Buyer could be a resident person or a non-resident person. Now, this is where the entire obligation is casted on the buyer. So whatever is the tax rate that's applicable to the seller on the gains it makes, the buyer is supposed to collect those taxes. There may be scenarios where the seller may tell the buyer that there is no requirement to withhold tax because the seller is either exempt under the treaty or the seller is selling the shares at loss. But in each of those cases, the buyer wants to make sure the position is actually so. So where it comes to computation of taxes that the buyer is supposed to deduct, the buyer will actually ask the seller to provide a tax computation in a detailed manner, usually from a Big Four accounting firm that sets out the exact obligation. When it comes to a treaty claim by the seller, the law is not absolutely settled. There may be cases where the seller's claim to treaty may be denied, and the buyer wants to make sure that a Big Four accounting firm or other reputed accountant actually looks at the facts of the case and comments that the seller is actually entitled to the treaty benefit. Generally, they try and see that it's not a case of mere treaty shopping and actual commercial substance is there in such treaty country. Just to quickly cover, Netherlands, Mauritius, Singapore, and Cyprus are the countries where capital gains exemption has been available from direct transfer. While for Mauritius, Cyprus, and Singapore, the exemption is not available anymore. Any shares acquired before 2017, a sale of those will still be exempt. While the seller provides these documents, such as the tax computation and a tax opinion, the buyer wants to make sure it also takes a representation from the seller that any information provided by the seller to the accountancy firms is actually true and accurate. And if there's any claim in taxes subsequent to breach of such representation, the buyer is adequately covered. So buyer would want a robust representation and indemnity to protect itself. The second set of withholding obligation is in the second bucket, which is a purely domestic transaction. This is where the seller and the buyer are both residents. Now, historically, there was no withholding of tax on acquisition of shares when the seller was a resident. This started only 2 years ago. And as you can see from the rate of withholding, which is just 0.1%, the intention is clearly not to have early collection of taxes. The intent is actually a big brother approach being played by the government, which is they want such transactions to be reported in the system. However, not every buyer will have that obligation. It depends on the business turnover that is there for the buyer. The intent was to only further burden those buyers who have large finance teams otherwise assisting them. The third bucket is where the seller is a resident, but the buyer is a non-resident. Now, generally in such cases, the buyer should not be subject to withholding obligation until and unless they have a taxable presence in India, what we call permanent establishment. The last item is tax collection at source. Now, tax collection at source is actually a seller obligation, but a buyer should be mindful that the seller may ask the buyer for additional amount to collect at source. So just to give you an example, where tax collection at source is applicable, say the tax to be collected is 1 and the consideration payable is 100, the seller will actually have buyer pay 101 and will pay 1 to the government, and the buyer will get credit for that 1. TCS, what we call as tax collection at source, is usually applicable where the buyer is not withholding the tax. So these could be cases where the seller is either claiming treaty benefit or selling at loss. Likewise, the seller would have to meet certain thresholds for this to be applicable. Next slide, please. We'll now talk about pricing provisions and valuations applicable in case of a share acquisition. Now, under tax laws, there are certain anti-avoidance provisions that are there, which apply to a transaction of sale of shares which happens at a value which is under the fair market value. The intent of the law is to levy a deemed tax on the seller and equally a deemed tax on the buyer. Therefore, there can be a double tax where a transaction takes place at a value below fair market value. So to give you an illustration, if the fair market value is 100 and the shares are transacted at 80, the seller will be treated to have received 100 and hence will have to pay deemed tax on the differential of 20. For the buyer, the government views as if the buyer is able to acquire shares which are otherwise worth 100 for 80. Therefore, there is this benefit of 20, and that will be treated as income and subject to tax at highest ordinary rate that's applicable to the buyer. Therefore, it becomes very important for a buyer to be aware as to what is that fair market value and whether there can be any deemed tax for the buyer, and also for the seller to know that they are not treated as an agent separately for further recovery of tax. Now, there are prescribed methodology that is there to compute the fair market value of shares, but it depends on the nature of instrument. There is a separate set that applies when preference shares are being transacted, and there's a separate method that applies to equity shares. Given that the company is generally under the control of the seller, as part of the deal, the buyer will usually ask the seller to procure a valuation from, again, a Big Four or reputed advisor and furnish that to the buyer. The buyer would also want to make sure that there are robust representations and indemnity for any sort of breach around this. For instance, the buyer would want to make sure that any information that is given by the seller to the valuers is well backed by a representation. And if there's any claim of deemed tax on the buyer, it is also covered by an indemnity. There's another instance where deemed tax can still apply in case of a primary transaction. So we just talked about a secondary acquisition by a buyer, but where buyer is infusing money and subscribing to the shares of a target, there can still be deemed tax, though the tax is in the hands of the target and not the buyer. And this is called the angel tax. The tax is on the differential between the amount that is paid over and above the fair market value. Again, there are set rules that compute how a fair market value will be there, and the differential excess amount is subject to tax in the hands of the target. There are a few exemptions from angel tax. So first is where the investor is actually a non-resident, and second is where the investor is an AIF category 1 or 2. The intent of these exemptions is to not regulate transactions that are otherwise regulated. For instance, NR investments are regulated by RBI and AIF by SEBIs. The third set of exemption is where the target itself is registered with DPIIT as a startup and adheres to several other conditions that are there to get such exemption. So that was our sort of talk on the deemed tax that is there. Very important for the buyers to be mindful of what the fair market value is and ensure that the transaction is at or above such fair market value, and there enough documentation protection if there is any mismatch. Next slide, please. We will now talk about Section 281 concerns. Now, while people are anyway scared of income tax as a subject generally, and when we take names of section numbers, they get further scared. But Section 281 is so infamous, it has its own colloquial reference in M&A transactions. So what is Section 281 and why is it so important? Well, effectively, the buyer can lose title to the shares it has acquired if the seller had any pending tax claims and dues at the time of transfer of shares, and the seller defaults in payment of such taxes. The intent of the provision, again being anti-abusive in nature, was to keep sellers from siphoning off assets when there's an impending tax claim. Therefore, the provision really applies when the seller sells shares during pendency of any tax proceedings, or if there's already a tax demand that's outstanding and the seller fails in meeting such obligations subsequently. While there is a defense of a bona fide purchaser, which is really that where the buyer is not aware of any tax claims against the seller and buyer is paying an arm's length price for the shares, the buyer should not be held responsible under Section 281. However, generally the buyer would not like to pick up on litigation and would want to make sure instead that there is no pendency of claims against the seller. One certain way for a buyer to have a comfort around this is to have the seller go to the tax office and get a no objection certificate clearance from the tax authorities. However, that involves dealing with the tax authorities and is not always as smooth. While the NOC can come as soon as 10 days, in some cases it may take longer. Therefore, an alternate that is considered in an M&A deal to facilitate is to actually get comfort that the seller does not have any pending proceedings and claims. where a seller could get a certificate from a reputed accounting firm who would do a limited diligence to see if there are any claims outstanding. With the whole digitization of tax claims process, any tax claims should ideally be shown on the tax portal of the seller. So when such certificates are given, usually screenshots are also provided which reflect that there are no pending proceedings and due to give added comfort. This is also the approach that is generally advisable when dealing with non-resident sellers, because generally they will not have enough touch points interaction with Indian tax authorities to have claims. Next slide, please. Another very important aspect that a buyer needs to keep in mind is target level taxes that are there. So when shares are being acquired, like we discussed, it's a separate legal entity, the target, and it will have its own historic tax issues. So as part of that, the buyer would want to carry out a detailed tax diligence. The intent of the diligence is to ascertain if there are already any ongoing proceedings that are there against the target, or otherwise find out if there's a possibility of tax proceedings arising in future. So one would look at the different tax positions being adopted, whether they are actually settled law, is there a possibility of tax claim coming, have there any aggressive positions being taken, all that is usually assessed. Parties generally would try and agree, both sellers and buyers, in terms of the risks that are there and grade the level of risk. If the risk is very high, ideally a buyer would push the seller to make a pricing adjustment to say, let's keep some money aside for meeting those tax claims. Usually an escrow mechanism may also be considered. But for other risk where there is a defensible position available, the parties would generally agree to just having representations and a specific indemnity around it. Another item over here, which is very important, though not technically a diligence item, is that any brought forward corporate losses, tax losses, would not be available to carry forward if the buyer acquires more than 51% shareholding of the target. So therefore, buyers generally would not price such tax losses in the transaction overall. Next item, please. Next slide. We've talked about the key tax concerns that are generally there for a buyer in a share acquisition. When we look at the share transfer documentation, the share purchase agreement, as tax advisors on the deal, the first thing we usually look at is the indemnity clause and the extent of indemnity that is there. Now, generally, you want the coverage to be wide enough to cover for all seller taxes that can be there and all target taxes that may arise. Therefore, you will have the conventional indemnity around any breach of representations, but you would have a specific indemnity for any pre-closing taxes of the target. That is, any taxes that arise either historically or on account of an event that occurred at the time of closing or prior to closing. The claims that have come to the target, it should be well indemnified for it. The next two items are technical terms, representative assessee risk and assessee in default. Technically, these are to cover the buyer against any taxes of the seller. So generally, the buyer would withhold tax, but if there's any shortfall, there could be a claim on the buyer. Or if there's otherwise a tax payable by the seller and buyer is treated as an agent, the buyer wants to be protected against this. So these two items would cover for that. And that's what we would look at for a buyer to have an extensive indemnity clause. The next two items are heavily negotiated in most transactions, and that is what should be the survival period of such indemnity and what should be the monetary cap on such indemnity obligation of the seller. Now, the answer is probably very simple when you look at it from a buyer perspective. That is, it should be indefinite period and it should be uncapped. Why should a buyer be asked to go out of pocket for any claim that is owing on account of seller's taxes on which sellers made the income? Having said so, commercial realities do result in parties negotiating around what should be the survival period and cap. You also have private equity sellers who generally like to sell the shares and then liquidate the fund and distribute the proceeds and don't like an obligation to carry indefinitely. In terms of the indemnity period, well, the tax law has a limitation period of 11 years. It was proposed to be 4 years, a shorter period, but with the subsequent changes, arguably 11 period can apply in most cases. Therefore, the buyer would generally like to have 11-year period, while generally they're comfortable with the historic limitation period before the change, which was 7 years. So parties look at anywhere between 7 to 11 years as the indemnity period for survival of the indemnity clauses. In terms of the monetary cap on the indemnity, when it comes to indemnity around withholding tax, and especially in cases where the buyer has not withheld taxes because the seller has claimed a treaty benefit, well, they generally look at the cap to be tied into the survival period. So what they would like to cover is the basic level of tax that may be there, another 100% amount which will be equal to the penalty that may arise, cover for interest for the period, which is generally 12% per year, and then litigation costs. So for instance, if the survival period agreed is 7 years, one could look at a multiplier of about 2.84 of the basic tax that may be agreed as a monetary cap, which should ideally cover the buyer. Insurance is a great product that helps in bridging the gap and any disconnect that may be there in terms of indemnity being provided and the extent of it. There are insurances as representation and warranty insurances to cover for target level taxes, the pre-closing taxes. And there are also specific products to cover for any withholding taxes, especially in treaty scenarios. And now there's also some talk about having insurance product around 281 risks that may be there. While we talked about the indemnity, the extent, the coverage, another element which is equally important is the tax claims process. Now, tax claims process is one area where the seller can actually wriggle out of its obligation or make it very hard for the buyer to make any claim. Buyer ideally would want to make sure that the tax claims process is such that the indemnity nature is such that it is not reimbursement. That is, buyer doesn't have to go out of pocket at any stage. The seller has to make good any claim amount and has to pay it directly to the tax authorities, or in the alternate, pay it to the buyer well in time so that the buyer can make the payment further before the due date. Given that the seller is giving an indemnity, it's natural for the seller to be involved in the claims process and also lead the defense on any claims that may be there. The buyer should have the right to participate in such defense as well. However, in the event the seller does not lead the defense or does not carry on with the defense, buyer should have a free right to abandon the defense and settle it with the tax authorities if it so chooses. Next slide, please. We'll now talk about the second mode of acquisition of business, which is business transfer, or what we also call technically a slump sale under the Income Tax Act. And that applies where there's transfer of a business as a going concern and there's a lump sum consideration that's payable for it. Generally, there is no cherry picking of assets and liabilities when a slump sale takes place. However, there is some leeway so long as what is being acquired by the buyer can be run as a going concern. Next slide, please. From a tax implication perspective, again, the watch outs for a buyer, I think the most important one is actually from a GST perspective. That is, if the buyer acquires the business on a slump sale basis, a going concern, the buyer would not have to suffer any GST. However, this is not probably a gating item where buyer otherwise has the ability to use the credit of the GST against any other output tax liability it may have. Coming back to the income tax, there is a concept of successor liability, which is taxes payable by the seller, not just on the transfer of the business and the gains on that, but also taxes payable on account of any income from the business in a window of 2 years prior to the transfer. So the successor liability construct is pretty wide. And if the seller fails in payment of such taxes, then the taxes can be recovered from the buyer by the tax authorities. So again, the buyer would want to have a limited diligence to understand the level of successor liability over here, and of course have very robust contractual protection in case of indemnity. Acquisition of assets is also an opportunity for buyers to capitalize self-generated assets of the sellers. These are usually intangibles, so a source code, an IP, or generally a customer contract. Goodwill is not available for depreciation anymore after the recent change in law. Now, in case of a slump sale, ideally the buyer should not be required to withhold any taxes, but then it must truly be a slump sale of a business as a going concern. There are cases where there are transfer of large assets such as immovable property, etc., which are masked as a slump sale, or immovable property has a very high value component in there. So there the buyer may want to be mindful and as an extra cautious exercise may want to withhold taxes which are otherwise applicable on acquisition of an immovable property. Deemed taxes that are otherwise applicable on discounted acquisition of an asset should ideally again not apply to a business undertaking, but again, it should actually be a transfer of a business undertaking. And if again, there is immovable property, which is a large component, the buyers may need to be mindful. There are two views whether Section 281 applies on a business transfer or not, and that is because Section 281 expressly covers certain set of assets. So one view is because 281 does not prescribe for an entire business undertaking, it should not apply. The other view is if the undertaking constitutes of the assets which are otherwise covered in 281, 281 should apply. Naturally, for the buyer, a better view will be to have the seller go to the tax office and get an NOC, even in case of a slump sale. Now we'll move to itemized transfers. Next slide, please. So itemized transfers are where instead of the entire business as a going concern, individual assets are being acquired and a value is being attributed. These are fairly common in tech deals where source codes and softwares and intangibles are being acquired. Next slide, please. So we'll talk about the other tax implications and touch points that are there for the buyer. Here, GST will be applicable, and the exemption that is there for acquisition as a slump sale would not apply. Withholding would apply in this case, depending on what is being acquired. So whether the asset that's being acquired actually is treated as goods or not, the withholding would depend on that. Again, generally the rate of withholding may be 0.1%, but it needs to be looked at depending on each asset that is being acquired. Deemed taxes that apply on discounted acquisition of an asset could apply depending on the nature of assets. Usually it is shares, immovable property to which such provisions apply. So if it's plant, machinery, intangibles, the deemed taxes may not apply. Likewise, Section 281, like I articulated earlier, 281 applies to certain assets that are being transferred. So it must be seen if the asset falls within the purview or not. And if it does, then the comfort and protection against 281 must be acquired. Now, in terms of tech deals where intellectual property is being acquired by the buyers, it's very important to check the verbiage used in the contracts. If it is not an outright transfer of all the rights, the tax authorities may view the payment as royalty, even though it's one-time payment, in which case the buyer may have a higher withholding obligation. So it's very important to make sure the document is worded in an aligned manner. And to end on a good note on this, there should not be any successor liability when an asset is being acquired, of course, keeping the 281 concerns in mind otherwise. Next slide, please. Now, in terms of key takeaways that we had from today's presentation, like we discussed, withholding obligation is a very important element. So any buyer, before they pass the monies and give away the consideration, they want to make sure they've withheld the taxes that otherwise would be payable by the seller. They put in place a process where they get to know what exactly should be such withholding obligation, and they have a fallback in terms of representations, warranties, and indemnities, and in cases even insurance, to ensure that no obligation of the seller in terms of their taxes comes upon the buyer. We talked about the pricing provisions that apply on tax transactions. So very important to ensure that there is no deemed tax that's payable by the buyer, and any transaction being done actually happens at fair market value. And there is enough comfort again to know that fair market value indeed is robust, the valuation is proper, and if there's any claim, the seller would be held accountable for it. We talked about successor liabilities in the form of 281 and what one can do over there, get a tax clearance, or in the alternate, get a CA certificate. And we talked about the importance of tax diligence in a target and having specific indemnities to cover for any risk. We talked about the contractual documentation and the package that one has, the extent of indemnity one would want to cover for, the claims process that should be there, that should be very robust, and important aspects such as survival period of that indemnity and any cap that may be there. So with that, we end the presentation, and we'll be happy to take any questions that may be there. Back to you, Sameer. Thank you.
Thank you very much, Indruj. And what a fantastic presentation. We'll give you a minute to catch your breath and grab a sip of water. There's a whole host of questions I've been struggling with, and maybe just give me a moment. I'll try and run through them. Wow, there's a lot of questions on successor liability in asset transfers and business transfers. So maybe why don't we pick up with that, because that's probably the last topic you spoke of. So there's a question: what is the statutory genesis for successor tax liability for buyer for 2 years?
Sure. So Section 170 of the income tax is what covers this. And again, you know, all these provisions are very old provisions that sought to cover probably an era where there was actually restructuring taking place. And, you know, one was sort of moving assets and thereafter, again, siphoning off assets to say, look, I have a tax claim now, but I don't have the asset anymore. I made monies from this business. I don't have the business anymore. Monies I received are spent, or otherwise I transfer the business not in such a profitable manner. And I don't have the ability now to pay taxes. If the seller does pay the taxes, there is no successor liability that comes on the buyer. So it's those provisions which historically sought to cover, within group restructurings, if one may call it. But it uses the word succession. And courts have viewed the word succession in such a wide manner to say any acquirer of a business is actually succeeding to that business. Now, whether it's within the group, whether it's by way of a court scheme or not, it would do so. So again, these are anti-abusive provisions, and one can of course understand the apprehension that a buyer has, because as a buyer, I'm paying for something I'm acquiring, I'm paying market value for it. Why should I still be responsible for seller's taxes? So yes, there is, it's very understandable the apprehension a buyer has. But then the buyer has to exercise certain caution to ensure they don't pick up a fight with the tax office later on and are well protected.
Okay. Now, the next question is connected, and I'll take a word that you said the buyer should exercise caution. And I have a feeling you addressed this when you spoke in the presentation, but the successor liability risk, how should it be mitigated by a buyer in a business acquisition?
Sure. So, Sameer, just to articulate again, what are we trying to mitigate against, right? So there are two parts to it. One is that the taxes that the seller will have to pay on the transfer. That's one part. Second is any taxes that the seller anyway should have paid, right, in the past 2 years on the income it earned. Now, second part you can have visibility on in a way. You try and do a diligence to see, okay, what was your income? Please show us your tax returns. Please show us your accounts. You look at the income that they want. You try and assess whether the tax have been paid in the right manner or not, or is there something that's standing out? So that is one way where you do a limited diligence on the second part. On the first part, it's a little tricky because the seller doesn't have to pay the tax on the same day. And if the seller is an unrelated party, they'll say, well, I'm giving you comfort. Why do you want me to pay taxes early? No, Income Tax Act permits you to pay taxes in tranches under advanced tax regime. Of course, on capital gains, you have to pay it in one tranche sooner. If the buyer is nervous, especially given that, they either are not comfortable with the repute of the seller and feel that the document protections may not be enough. There have been some cases where we've had large companies dealing with smaller buyers, smaller sellers, and they've actually, what they've done is they've withheld the tax amount, paid it under the PAN of the seller. So it's as good as if the seller is paying the taxes on that date itself, but they never let the seller come into money. And we've seen them but that may be a very extra conservative approach. That is, they may not be deal friendly. So, but there may be situations that call for it in an extreme sense.
Sure. There are two slightly foundational questions on business transfers, and with that, then after that I'll move to shares. So okay. The first is, how do you distinguish between a business transfer and an itemized sale? And I'll just give you the second one, which is, given asset sales don't attract successor liability, are they not a better option for a buyer as opposed to a business transfer? So why don't you address both of these?
Sure. So for a transfer to qualify as lump sale, there are two key ingredients. One, there is transfer of an undertaking, which is transfer of a business as a going concern. So it's not just transfer of, I pick assets and liabilities that I want, or just some assets. It's transfer of an entire business venture undertaking. So the undertaking test has to be met. That's one. And second, it is for a lump sum consideration. So there is no allocation to say, okay, this much for the immovable property, this much for this. If you have to allocate a value for immovable property for stamp duty purposes, that is permissible. But otherwise, you're paying a lump sum amount for an entire business undertaking as a good. Mostly parties like to cherry pick a little bit to say, you know what, I don't want that liability. I don't want those assets. I don't want all employees. How do you really look at it? Though technically employees are not assets, but how do you then do that? So and this has been heavily litigated, Indian courts have looked at it and they've said, you can cherry pick a little bit, so long as the buyer, when it acquires the undertaking, can carry on with the business. It doesn't have to add on from itself to the very core to make it a complete business, right? So you can't say, I'm just taking one machinery, I'll not take anything else. The buyer can, then buyer will have to add on a lot to turn it into a running business. So that's on, but this is a very good question, and this is something that authorities will always have a keen eye on, because this, and my partner Ritu, when she does the next session, she'll probably cover this. But this is actually a seller concern, where seller wants to make sure it's a transfer of an undertaking because they get favorable tax treatment when they sell. From a buyer, the favorable point really that stands out is what we discussed was the GST. And both GST and income tax authorities are likely to view the undertaking test in a similar manner. Now, the second question, Samir, sorry, what was the second question that we had?
Given a business transfer doesn't have successor liability, isn't it an obviously better structure? Sorry, it's the other way around. Isn't an asset transfer an obviously better structure?
I think I accidentally answered that question while concluding the first answer, which is, for a buyer, you want a slump sale because there's no GST. But when you're acquiring simply assets or paying for services, there's a GST element likely to be 18% in most cases that you'll have to sort of pay. Now, if you have the ability to set that off and does not impact your cash flows, then it may not be much of a concern. But yes, you're right. I think that's a very good question to say. Historically, I would say slump sales were preferred by buyers also because any excess value that you paid over the assets could be treated as goodwill, and the buyers can then claim depreciation to reduce their taxable profits on that subsequently. But 2 years ago, the legislature said that you can't claim depreciation on goodwill. So the lure then is not there anymore for a buyer from an income tax perspective, but from a GST perspective.
Understood.
On the slump sale. So you're right, asset acquisition is probably better from an income tax perspective.
Right. Maybe we switch to share acquisition, and there's a specific question on share swaps. In fact, there are 2-3 questions on share swaps. So one is, what withholding tax implications do you foresee on a share swap structure?
Okay. So, firstly, before we get into withholding is nothing but a mirror obligation of a seller's tax liability. So before we get into withholding, I think it's important to understand that a share swap is not exempt, even though you may swap shares of 2 entities having the same value. So say both parties acquired shares for 100, and today they're swapping the 2 sort of set of shares for 1,000. So one may say, well, I'm giving 1,000 and I'm getting 1,000. Mine was valued at 1,000. Why should there be a tax? Well, the taxing event here, and there are several, sort of international jurisdictions. There are several countries where share swaps are exempt because they see that there is no sort of benefit. There's no coming into money from either of the parties. They're just replacing their asset for the like value. But under Indian tax law, how it is viewed is that that it's a transfer, and you acquired something for 100. Now you are monetizing it by getting another asset for 1,000, and the differential of 900 is actually your gains, and therefore you must pay tax on that, even though you sort of get your own asset was at a fair market value of 1,000. So the gains that had otherwise accrued get crystallized, and it is seen as if you received a consideration, even though it is in kind. Now here, depending on the seller, whether the seller is a resident or a non-resident, and for each party there'll be a seller and there'll be a buyer. Depending on for one party which is acquiring the shares and the other party which is transferring, whether that party is a resident or a non-resident, the withholding obligation will be ascertained accordingly. Now, where the seller in one case is a non-resident, the buyer will have to withhold tax on the entire amount that otherwise will be payable by the seller. And the difficulty that's faced is that this is an in-kind transaction. So I'm actually giving my shares. How do I withhold, right? And if I was to sort of pay the taxes out of my own pocket, that may be seen as grossing up, and that actually results in a higher tax amount that's payable to the government. So a way where parties may sort of resolve for this is that the buyer, while giving his shares, may tell the seller that, look, you have to pay this tax anyway. I have a withholding obligation. Why don't you pass the amount of cash equal to the amount of tax that I have an obligation to pay? You give it to me and I'll pay that tax. So that's the way how a buyer can withhold the taxes. Now, it may just be if both are non-residents, both are also buyers, both are non-resident sellers, both also buyers. So it's a swap scenario. So it's a mirror obligation by both. So you may have both parties sort of exchanging cash to pay their own sort of taxes as each other's obligation.
Understood. There's a question here on swaps, whether deemed tax will apply on a shared swap transaction. I think they're referring to the valuation points.
Absolutely. Like we discussed, I mean, swaps are not exempt under Indian tax law. So, but it becomes extremely challenging in terms of how do you ascertain those deemed taxes. So it's a very tough question in that way, because you're doing a transaction for kind. So how do you really value? So first instance will be, say if I speak from one party's perspective, and deemed tax, say we speak from one party being the buyer. Now the shares that I'm receiving, if I receive those shares at a discount, then there is a deemed tax. So first I need to know the fair market value of the shares that I'm receiving, right? Which depends on the nature of the shares, whether they're equity shares or whether they are preference shares. The fair market value is computed accordingly. Then we need to see at what price have I acquired them for, and what is my price that I've given? I've given the shares. So then I need to value the shares that I've given. And over there, most likely you'll value those shares that you've given for, say, a market value basis on an open market DCF basis. So where the value of shares that I've given is sort of higher, it's lower than the value of shares that I've got, then in that case, the differential will be treated as my deemed income as a buyer, and the tax will be payable. But yes, to answer in summary, deemed tax provision and withholding tax provisions that we discussed during the slide are equally applicable to the swap also.
Understood. Then there's one question around NRIs, that if a seller is an NRI holding shares on a non-repatriable basis under foreign exchange, do they still require withholding tax because they are treated as residents for FEMA and FDI purposes?
So the definition for income tax purposes of a non-resident is not connected to FEMA provisions at all. One would have to look at the definition that is there under the Indian Income Tax Act. That definition is linked to the number of days one spends in India. It's a very objective test. As I understand from FEMA, it is objective read with subjective, so the intention also matters there. But for Income Tax Act purposes, it is only an objective test. It depends on the number of days that a party will sort of spend in India. And if a party is a non-resident for income tax filing purposes, then the withholding obligation will be there on the buyer, regardless of what the status may be for FEMA purposes.
Understood. Just on tax indemnities, there's one question, which is with respect to tax indemnity period for 7 years or 11 years, just wanted to check, when does this period commence? Does this commence from the year of closing of the transaction, or from the period when such pending tax litigations are settled by tax authorities?
So, and Samir, the question is in reference to the document survival period or statutory sort of?
I think it's a mix of both, but they're probably referring to your tabular summary of the 7 years and the 11 years and so on.
Got it. So in that case, it is completely contractual. Parties can decide that if, say, for instance, they agree to a period of 7 years, right? Parties will decide when should that 7-year period start. Does it start from closing? So it's about the survival of the indemnity and survival of the indemnity post closing. So any claims that come within a period of 7 years has been agreed between the parties will be covered by the indemnity. Now, whether the parties want that 7-year to start from the date of closing can be contractually agreed, and naturally the buyer would like it that 7-year period actually starts from the end of the financial year in which the closing takes place. But these are again terms which are negotiated between the two parties, and there is no sort of set, but yes, as a first ask, buyer will generally say that have the period start from the end of the financial year.
There's one question on tax insurance, which is how commonly is tax insurance being used where parties can't arrive at a conclusion on withholding tax indemnities?
Sure. So I would say it's not extremely common. It is definitely something that the parties look at. I think the reason for that is commercial. There is a high premium that's payable for taking any insurance. So, if the buyer wants to push that coverage on the seller, upon the buyer in that sense to say, well, am I okay with the kind of contractual protections I have here? And it's probably more important in cases like a treaty exemption. Now, just to sort of dig a little deeper into it, like we discussed earlier, a treaty exemption claim is not a given. A seller may be entitled to the treaty, may not be entitled to the treaty, and the tax authorities may view it very differently. Again, the issue has been really historically litigated a lot and probably beaten to pulp in that way. You've had Supreme Court litigation, you have AR litigation on this, you have department circulars that have dealt with it. So in that case, what probably the buyer could do before jumping to an insurance, and I think the insurers will also do this, is to first try and see what is the level of comfort that they have from the Big Four opinion that is provided by the seller. Because the Big Four opinion will try and cover all those elements that have been looked at by the courts over the years. So of course, as buyers advisors, we'll also look at the report that's provided by sellers advisors to see, is it robust enough? Is it covering for commercial substance requirement in a true sense? Are there really independent, capable directors that are there? Do the board meetings really take place? So, the buyer can get a little bit more involved in the exercise instead of just being apprehensive and nervous to say, well, this is a definite case and I want to jump on insurance. Because like I said, there's a cost to it. So, maybe I'm taking a step back to your question to say, what does it take to reach to that stage? And what you may do thereafter. So I think the diligence part is very important. Have the sellers advisors do it, but have the buyers advisors equally involved. And then if one feels that, that intrinsically one is not comfortable with the overall structure or what the seller has in place, or there are certain doubts that are there, then the buyer may sort of look at going to an insurer. And we've seen this happen a lot. We've advised rather several insurers also who, before underwriting any risk like that, will come to us with the seller's sort of opinion that has been given by the Big Four to see, why don't you also do a diligence to see, is there a level of risk? How is this to be viewed in terms of how historically the courts have viewed it? But I think from what we've seen, 5 to 8% may be the sort of coverage payable, as an insurance premium. And that will again depend on the quantum of a deal, whether the parties really want to go for it. There have been cases where, because of certain facts standing out for the sellers, the buyers have managed to negotiate sharing of premiums. But then there'll be cases where buyer, for his sole comfort, has sort of gone for it. That is around the withholding tax. There is also an insurance product for representation and warranties that are there for the target entity. Now, in sort of global deals where there's an Indian transfer happening, I would say that's probably an area where it's fairly common for buyers to be able to go for insurances. And this happens a lot in sort of either distressed deals or otherwise bid acquisitions, right? You want to, as a buyer, sort of stand out for your practicality. You don't want to burden the seller with too many strong sort of robust indemnities. In that case, you may say, well, you know what, I really want, this is a bid deal, I can make an attractive offer, and if I'm getting it, I'll rather bear my price separately for insurance instead of trying to really ask for onerous indemnity coverage from a seller, and sort of lose attractiveness on the bid.
Understood. So I'm conscious we will eventually be running up against time, so I'll pick some questions which are a little bit more interesting. This wasn't on your slides in that much detail. The question is, sometimes an earnout helps bridge buyer and seller expectations on price and company performance. Are there any specific tax issues that a buyer should be mindful of?
There are, and again, just like every other topic, heavily litigated. So the tax view and market view is again sort of varied depending on the nature of the transaction. And that goes back to whether, is it really a earnout in a true sense, that the amount that one may earn is not known, it's contingent, it's subject to performance, or are we talking about deferred consideration where maybe the amount is known, but it's deferred to a later point, again, depending on contingencies. So while the tax concerns, there are actually two different tax concerns, but I think the tax concern is really large for the sellers. And really the moot point here is, should the seller be paying tax on the entire amount of the consideration, including earnout or deferred consideration payable in future, in year one itself, in the year of transfer of shares, or is that subsequent payment amount of either earnout or deferred consideration payable as and when one sort of receives it or is entitled to receive it? Now, as a general theme of income tax law, one is liable to pay tax when there's accrual of income. So if I'm entitled to receive monies, and if I follow accrual method or otherwise, then the person will pay tax then. But unfortunately, when it comes to capital gains, the accrual is deemed to be in the year in which the seller is sort of partaking with the asset. And even though earnout and deferred consideration is payable in future, there's a view that the tax authorities have a right to recover taxes from the seller in year one itself. Now, but this is for the seller. Why does buyer bother? Buyer bothers where there may be a withholding obligation. So you still have earnouts and deferred consideration for non-resident sellers selling shares, right? So if the buyer does not withhold tax on the entire amount, then and especially say for instance the buyer says, well, even I'll withhold in a subsequent year, but the tax authorities raise a claim to say, no, you should have withheld in year one when you made the payment, then the buyer is in a problem. So buyer also has to take a view, and usually buyers will push the seller to say, look, while there may be a case law to defend that taxes are payable in a subsequent year, we don't want to litigate. We will withhold on the entire amount. You may please take your position. You will get credit for whatever we withhold. As a seller, you may please take whatever position you want in your tax return and claim a refund if you so want. So that is where the buyers want to be very mindful. And actually, there are a lot of creative structures that are looked at by the parties, which sort of deviate a little bit from earnouts, etc., to try and achieve a position which is good both for the sellers and buyers, which actually defer the taxing event to a later date. That's one part. The other part is, in many instances when it comes to earnouts, the buyer want promoters to continue to handhold them. So buyers put a condition with the earnout to say promoter must be in employment on that date, right? When they're acquiring a business, especially, or otherwise, they want to make sure that the promoter stays with them for 2 years, 3 years, or longer. So they say, it's not just about the monies we make from that business or company. We also want you to continue with us at that date. And if the earnout is linked to the employment, and if the promoters will not, or the seller will not be entitled to earnout because they're not in employment, then the tax authorities may seek to recharacterize the transaction to say, well, is it really towards earnout, or it's towards the employment of the promoters in the same entity, or if it was business acquisition, then in the buyer entity. And if it is treated as towards employment, then the buyer may have an obligation to withhold tax at a higher rate as it would have had it paid salary amounts. So again, it becomes very important. So it's a very good question. There are many aspects that are there for sellers and buyers, but a lot for buyer to look out for. And again, in each instance, ensure that the withholding obligation happens at the highest, on the highest quantum at the highest rate.
Understood. There's a question on global sales. So our company is a subsidiary of a global group and has been sold as a part of a global transaction. What compliances / issues should we as the Indian subsidiary be mindful of?
So I think, Sameer, what is being referred to over here is what we refer to as indirect transfer of shares, I believe. So just to give illustration and for everyone's benefit, say there's a company A, which is say in US, and it has a wholly owned subsidiary company B in India. Here we are talking about a global transfer where the shares of company A are being transferred, maybe to say a foreign buyer. So foreign seller and foreign buyer, and shares of company A are moving, and along with that, company B is moving because the shareholding of company A is moving. So this is what we call as indirect transfer, and what is also colloquially and infamously referred to as the Vodafone tax. So here again, for the buyer, there may be tax implications if the transaction otherwise is subject to tax, and seller is to pay tax, which will be if the value that is driven by the company A is substantially coming from assets that it holds in India, and that is the shares of company B. So if more than 50% of value of company A is actually coming from its holding in company B, then the tax authorities will treat as if it is a transfer of shares of an Indian company. It was basically an anti-avoidance provision to keep people from just transferring group companies when the underlying value being transferred is in India. In such case, the buyer would again have a withholding tax obligation. The buyer would again tell the seller, please provide me with a computation of whether the substantial value test is being met or not, how much percentage value, apportion the amount of gains that are payable to India, and tell me the withholding tax rate. So buyer will have to be mindful. And this is again a very interesting question, because when a transaction is happening sitting in US between US sellers and buyers of a US company, they never think of Indian tax in that way, right? So many of our clients get caught off guard on something like this, on withholding obligations, and then they suddenly get to know that they need to get tax registrations to discharge the withholding obligation. That adds to the deal times. It is usually something that it's good for parties to be aware well in time and incorporate in their deal times.
Understood. So again, I don't think we'll be able to pick up all the questions we have. Maybe I'll give you one last question. Question seems to be incomplete. I have a sense this is to do with the royalties on itemized sales that you spoke of. So the question is, what kind of verbiage should we use for a software acquisition, I guess, to take care of the royalty risk that you spoke of?
Sure. So I think, Samir, over there, again, the provision that defines royalty is very wide. So one would otherwise think about royalty in a very traditional sense, to say, I have a license to use something, I have to make periodic payments, just like a rental, if one may sort of compare it to. I have to make periodic payments to keep using that license. But the definition given in the Income Tax Act is so wide that it even covers, any payments for right to use that software, which are lump sum payments. But what is exempt from there is treatment by the seller of such amounts as capital gains. So one thing that the buyer would want to make sure is that it takes a representation from the sellers that the amounts that they're receiving under the transfer will be reflected as capital gains when they file the tax return. The buyer would also sort of put an obligation on the seller to say, once you filed, please confirm that you filed your tax return and you've taken a consistent position with the representation you've given. That is one aspect. The other angle to it is to just make sure that whatever verbiage is used, the perception that comes out of it shows an absolute transfer of rights. It is not seen as if there are some residuary rights still remaining with the seller, or the rights can fall back and come back to the seller in certain contingent situations. One wants to make sure, so the verbiage would be, and there are different ways to put it, but the perception that should come out from that is that there is an absolute outright transfer of all rights in that source code, software, and intellectual property by the seller to the buyer.
Great. With that, unfortunately, I must bring the Q&A to an end. The organizers have just highlighted to me that we are beyond time. Ladies and gentlemen, thank you. There were a lot of questions which we couldn't address, but as I promised, we will follow up after the webinar with written responses. Before we conclude, we'll request all of you to respond to the poll. It takes less than a minute. There will also be a separate feedback form which will be emailed to you. Please do take the time out to give us your feedback. All feedback is always welcome, and it helps us improve our offering and conduct similar such events in the future, which are useful to all of our audience and our clients. Excellent. Thank you to everybody who participated in the poll. And with that, just very quickly to summarize my key takeaways from today's webinar. Obviously, tax concerns are foundational, and not only do they affect the structuring of the transaction, they impact how you document it, and as Indruj has explained, how you live out the transaction even after you have documented it. So there's a lot to be done before, during, and after the transaction. And you obviously don't want last minute surprises, and hence I can't overemphasize enough the requirement to have expert advisors at your end involved from the very get-go. So with that, I'd like to thank Indruj for an absolutely simple, lucid, and stellar presentation of the buyer's vantage point of an M&A transaction and tax issues thereof. Thank you once again, Indruj, and thank you again to our audience for participating so actively, and the number of questions were simply overwhelming. So with that, if there's anything further you require from us, please don't hesitate to contact us. Our contact details are on the slide in front of you. And we look forward to speaking with you in another 3 weeks from now, when our partner Ritu takes on the seller's perspective of tax issues arising from an M&A transaction. Thank you very much.